Charles, the Fed has been in an easy monetary policy for quite some time now. There's research out there that some of the latest stimulus has had a diminishing benefit to the economy. And we saw in the latest Fed minutes that some of the committee members foresee quantitative easing potentially ending this year. Where do you stand on this?
Well, the Fed has certainly been in an easing mode for the last 4 years or 5. Interest rates have been at 0 now since close to the end of 2008. With interest rates close to 0, we have been buying assets. And most recently, we are now buying assets on a continuous basis, month by month. I think there's a lot of suspicion, both in the markets and elsewhere, that the effects of all that easing policy is having kind of diminishing returns. The payoffs, the benefits, if you will, are not as strong as they were at the height of the crisis. And I think that's probably right. So I don't think that right now, from my perspective, that the benefits to this policy really outweigh the costs. The costs are going to come down the road sometime when we have to stop doing this and then unwind from all this easing and shrink our balance sheet. And that could be a very touchy problem. Hopefully it'll go very smoothly. I'm not forecasting it will go badly. I hope it doesn't, matter of fact. But I think we have to understand there are some risks associated with that.
Now, there's some chatter out there that operating losses could occur if you don't end the program by the end of this year. Is that true?
Well, I think operating losses will show up when we have to start shrinking the balance sheet and we have to start selling assets. And if that becomes the case, then we could take on those long-term assets, we have interest rate risk. As interest rates go up, we can take losses on some of those. But we'd have to take a fair number of losses before they overwhelm our income. But it's possible down the road sometime that we would not be able to pay money to the Treasury as a consequence of this.
And then how does the market play a role in it? Because they tend to front run these. If they expect you guys to be unwinding those positions, right, you could see interest rates go up.
Well, that's actually one of my concerns, that as we get close to a time where we have to start shrinking our balance sheet and exit from all this accommodation, that the markets may anticipate that, and long-term interest rates could go up quite sharply and very quickly, and that would further make more difficult our exit strategy, because then we would have to keep up with that, which may mean we would have to raise rates very rapidly, which wouldn't necessarily be a desirable thing if we could avoid doing it. So that's just one aspect of the complications of getting out from under all this accommodation.
And then on the unemployment rate, the Fed overall has a target of 6.5% ultimately but your rate is 7%. You think we get there by the end of this year. So how does that?
Yeah, so let me make very clear. The Fed does not have a target for the unemployment rate.
Okay.
We have a target for the inflation rate, but not the unemployment rate. What we have said and what we did in December was indicate that we would not begin to raise the funds rate, our primary interest rate tool, until either the unemployment rate got to 6.5% or the forecast of inflation got above 2.5%. That's just a prediction about when we would raise the funds rate. Before that, however, because we're still buying assets, we would probably have to stop buying assets before we raise the funds rate, which means that we should stop buying assets well before we got to 6.5%. And different people have different forecasts of when that might occur. I think my forecast is the unemployment rates are going to come down in 2013 at the same pace they came down in 2011 and 2012, and that would put us near 7% at the end of the year. So that's just where my forecast is, and I would think that we should certainly by then not be buying assets anymore.
And then just finally, we got some resolution on the revenue side of the fiscal mess that we kind of have here, but we still have a lot of questions on the spending side. We don't know exactly where that's going to go. How could that impact Fed policy this year?
Well, you're correct. We have not had much resolution on the spending side, and of course, the spending is really what needs to be addressed. Mm-hmm. But Fed policy is really about hitting our goals on inflation and supporting the economy. I don't think Fed policy is dependent at all on what the Congress chooses to do on the fiscal side, or what spending they choose to cut or not cut. That's something for Congress to decide on, not something for the Fed. We need to stick to monetary policy, which is ensuring long-run price stability and promoting economic growth.